Okay, so before we get into anything today, I just want you to know this is one of those videos where I genuinely want you to pay attention. Like, not just have it on in the background while you're doing the dishes or whatever. I actually need you to sit with this one because the stuff I'm going to walk you through today, it's painting a pretty uncomfortable picture of where the markets might be heading. And look, I'm not here to scare you. I'm here to be honest with you, the same way I always try to be. So let's do this. Now, I should probably give you a little bit of context first. You may have noticed some turbulence in the markets recently, things getting a little shaky, a little unpredictable. And here's the thing, when I put together everything I've been watching, all the different signals and indicators and patterns, I keep arriving at the same conclusion. More volatility is likely coming. Specifically, I think the next stretch, we're talking into and through June, could be rougher than a lot of people are expecting right now. And I want to explain why, because it's not just one thing. It never is. It's a whole bunch of things converging at once, and that's actually what makes it feel more serious to me personally. So, I look at what the numbers are telling me, not what the headlines are saying, not what some pundit on television is excited about, the actual data. And right now, the data is flashing some warnings that I don't think should be ignored. We've actually been holding a meaningful chunk of cash at the moment because of this, and I'll explain the reasoning as we go through everything today. All right, first one up, inflation. And I know, inflation is one of those words that gets thrown around so much that it starts to feel almost meaningless. But stay with me here because there are actually two very specific forces at play right now that are pushing inflation up simultaneously. And that combination is what makes this moment feel different. The first driver is something that's been building for a really long time. We're talking years and years of deficit spending and money printing, especially here in North America. You pump that much money into an economy over that longer period of time, you end up with more dollars chasing the same amount of goods and services. It creates what I sometimes call a K-shaped economy, where certain parts of the economy are doing really well while others are struggling. But overall, there's just more money floating around. And that money chasing goods, that is inflationary. That's economics 101, but it's important context. Now, here's the second driver, and this one is very much a right now problem, oil. You know, there's conflict in the region affecting shipping lanes and supply lines. And what's happened as a result is that world oil inventories have been draining at a pace that is honestly kind of alarming when you look at the charts. The angle of that descent is steep, really steep. And the thing is, even if those supply constraints ease tomorrow, which is not looking likely anytime soon, we'd still be dealing with backlogs and disruptions for a while afterward. You don't just flip a switch and fix supply chain damage overnight. But here's the part that I really want to make sure lands. When most people think about oil prices and inflation, they think about gas at the pump. And yeah, that's a factor. But the bigger culprit is diesel. Diesel is what moves goods across the country. Trucks, freight, distribution, all of it runs on diesel. So when diesel prices climb, the cost of transporting literally everything goes up. And when the cost of transporting everything goes up, the prices of everything go up. Groceries, goods, building materials, all of it. So diesel is like the hidden engine of inflation. And right now it's adding pressure. And you want to know something interesting? There's actually a seasonal element to inflation that most people don't think about. There's typically a pattern where inflation tends to push higher during the warmer months. Driving season, vacations, increased fuel consumption, these things are fairly predictable on a year-over-year basis. But what we're looking at right now is inflation running even above that seasonal baseline because of these extra pressures I just described. So it's like the seasonal wind is already blowing in the direction of higher inflation, and then you've got these other forces adding fuel to the fire on top of it. Now, here's one of my favorite things to watch when I'm trying to understand what's really going on underneath the surface: the bond market, specifically yields on long-term bonds. And there's this saying on Wall Street that bond traders are smarter than stock traders. I've always kind of loved that saying because, I'm a stock person, not a bond person. And I think it's important to stay humble about where the real intelligence in the market lives sometimes. And right now, bond traders are pushing bond prices down, which means yields are going up. And the reason they do that is because they're pricing in expectations of continued inflation. They're not panicking. They're just being rational about what they're seeing. And what they're seeing is a future that looks more inflationary, not less. So what do you do with all this? Well, one of the things that has historically made a lot of sense as a hedge in environments like this is commodities. I've been talking about commodities for a couple of years now, and I think that call has held up pretty well. Oil, natural gas, those are areas where there's real demand and real structural reasons for prices to stay elevated or move higher. And then there's gold. Gold has been sort of consolidating recently, which some people take as a sign that it's running out of steam. But I actually look at history and I see something different. Back in the 70s, and I've done a full video on this if you want to go deeper on it, there was a Middle East conflict that drove oil prices way up, and gold didn't really explode until a few years later. It lagged, it followed, and I think we could be in a similar setup right now, where gold is just kind of biding its time before it starts to catch a real bid. I wouldn't be surprised to see gold make a meaningful move over the next year or so. Okay, let me shift gears a little bit and talk about something called market breadth, because this is one of those things that sounds kind of technical, but is actually super important and not that hard to understand once you get it. So when people say the stock market is going up, they're usually talking about an index, the S&P 500, the NASDAQ, something like that. And the problem is that those indexes are incredibly heavy in a small number of tech stocks. We're talking about a handful of names that have such enormous market caps that when those stocks go up, the entire index goes up, even if the majority of companies in that index are flat or going down. And that's exactly what we're seeing right now. The NASDAQ has been moving in a way that looks almost parabolic. The S&P 500 looks like a rocket ship if you glance at it quickly. But then you look at broader indexes, ones that aren't as tech-weighted, ones that include a wider range of companies across different sectors. And they're kind of going sideways, not making new highs, not really doing much at all. The Dow, the New York Composite, the TSX up here in Canada, these broader indexes are consolidating while the tech-heavy ones are flying. And that is a really classic sign of what I call a one-trick pony market. The whole rally is being held up by a very narrow group of leaders. Now, there's nothing automatically wrong with that in the short term. But here's the thing. When that narrow group of leaders starts to stumble, and eventually they always do, the rest of the market has to be able to pick up the slack. And if the broader market was already lagging, that's when you can get into some real trouble. And speaking of the leaders stumbling, let me just talk about the semiconductor space for a second. Because, wow, the semiconductor stocks have had a run that defies pretty much any reasonable measure of what's sustainable. There's a general rule I teach in my technical analysis course about what it means when a stock or sector gets more than 20% above its 200-day moving average. That's your warning sign that things are getting stretched. Well, semiconductor stocks got to nearly 40% above their 200-day moving average at the peak. 40%. That is deep into what I would call bubble territory. And when something is that extended, the reversion when it comes can be pretty sharp. And given that these are the stocks that have been carrying the whole market on their backs, their retracement is something the broader market is going to feel. There's also some really telling data when you look at breadth from another angle, specifically how many stocks within the S&P 500 are making new lows, even while the index itself is near all-time highs. When you see a large percentage of stocks hitting new lows, even as the headline index looks strong, it tells you that the strength is really just concentrated at the top. The foundation isn't as solid as the surface looks. And historically, when that condition has appeared, the forward returns over the next several months have been weak or negative more often than not. It's worked about 75 to 80% of the time going back decades. That's not a guarantee, but it's more than enough to make me want to keep my guard up. And then, layered on top of all the technical and fundamental stuff, there's seasonality. May and June are historically just more volatile months for equity markets. Even if none of the other stuff I mentioned today was happening, even if inflation was tame and breadth was great and everything was perfectly healthy, just the seasonal pattern alone would suggest more choppiness ahead. So the seasonal headwind is kind of the icing on the cake of all these other warning signals. Now I want to wrap up with sentiment, because this is honestly one of my favorite things to track, and I think it's one of the most underappreciated tools in any investor's toolkit. There's a famous index, you might have heard of it, the CNN Fear and Greed Index. You can just Google it, it's freely available. And basically what it does is measure whether investors are acting more out of fear or more out of greed at any given moment. And right now it's reading extreme greed. After all the nervousness that was in the market earlier this year, people have very quickly swung back to the other end of the spectrum. They're chasing. Every dip gets bought. There's a real fear of missing out driving a lot of buying behavior. And here's the counterintuitive truth about that. Extreme greed in markets is actually a warning sign. It means the crowd has gotten too comfortable, too optimistic, and markets tend to punish that kind of complacency. Conversely, extreme fear tends to mark the points where things are cheap, and it's actually a good time to be accumulating. Right now, we're at the wrong end of that spectrum. There's another broader sentiment indicator I look at that aggregates all kinds of different signals: options activity, institutional versus retail flows, insider buying and selling, crowd behavior patterns, and it's showing the same thing: excessive optimism. And historically, when this particular measure gets to these elevated levels, forward market performance has tended to be pretty disappointing over the following months. So look, when I step back and look at all of this together, the inflation pressures building from two separate directions, bond yields rising as traders price in a more inflationary future, market breadth that's incredibly narrow and top-heavy, semiconductor stocks coming off of what genuinely looked like bubble levels, overbought technical readings starting to roll over, seasonal patterns that favor more volatility, and sentiment at extremely greedy levels. I mean, that's a lot of arrows all pointing in the same direction. None of these things in isolation would necessarily be alarming, but all of them together. That's when I think it makes sense to at least take a step back and be a bit more cautious. And that's exactly what we're doing right now. We've got a meaningful cash position, roughly about 25%, sitting on the sidelines, and we're watching to see how things develop through June. We might put that cash back to work around mid-June, maybe late June, depending on what we see. We might deploy some of it and keep some in reserve. We'll be watching. We're not calling for a catastrophic crash or anything dramatic like that. This is more about risk management, about being sensible about the current environment rather than pretending all these signals don't exist. One area we're still very committed to is commodities. We like oil, we like natural gas. which has been starting to show some really interesting movement. Hard assets in general feel like the right place to be when you have inflation pressures building the way they are right now. And gold, even though it's been quiet lately, I think it's one to watch closely over the next year. The main message today is pretty simple. Be careful. Not paralyzed, not panic selling everything, but aware. The warning signs are there if you're willing to look at them honestly. The question is just whether you're prepared to act on them or whether you're going to wait until the risk is impossible to ignore, which is usually when it's already too late to do much about it. As always, I'll be back next week with more of this. Stay sharp, stay curious, and I'll talk to you soon.